On this morning's Ag Issues program, a pleasure as always to bring back to the program Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine, thank you. Good to be with you.
Well, and it's never, I don't know if I've asked you this before, never a dull moment, it seems like, as far as agriculture and tax law.
No, there has never been a slack moment in the 31 years I've done this. You never lack for having something to do. Let me tell you that.
Yeah, absolutely. All right, let's get right to it because we got several topics to discuss, and numerous times in the past, I know we've talked about the Packers and Stockyards Act that, of course, goes back to 1921. But specifically, talking about the numerous attempts to amend the Packers and Stockyards Act to create a dealer trust. And so explain what the Dealer Trust Act is that they would like to see in this, and the scope of it, and what is at issue.
Well, it's actually in there, Greg. It became a part of the Packers and Stockyards Act in 2021. But, of course, in general, the Packers and Stockyards Act applies to transactions in livestock and poultry that are in interstate commerce that involve a covered packer or dealer or market agency or swine contractor or live poultry dealer. And what it does, a couple of things very importantly to the discussion this morning, is it creates a statutory trust and requires bonds of market participants which may provide funds to reduce losses incurred by unpaid cash sellers of livestock or poultry. Just to bring this back home to more relevant to in people's minds, it was probably, about 5 years ago, we had the mess with the livestock barn out near Stockton, Kansas. What was the name of that town? It started with a P. I went out to Stockton and held a couple of seminars because on behalf of the public and then a private one for the cattlemen that were not getting paid by that sale barn. And of course, there's been a criminal process to that. The party involved was held criminally liable for what they did. But we've got a provision on the grain side of things. The Perishable Ag Commodity Act sets up a trust so that if you have, say, a grain elevator that goes down and can't pay farmers, then the money in there is held outside of the bankruptcy estate in that trust. That's the similar concept that the Dealers Act provides on the livestock side of things to make sure that unpaid cash sellers of livestock don't get tied up in the bankruptcy estate of the feed yard or cattle buyer, or however it's defined, the covered party, if they file bankruptcy after making the sale but not making payment to the livestock producers. And that came in 2021, and it became part of the Packers and Stockyards Act at that time.
So I know there is a case in the new dealer trust that's in court. This has to do, of course, a lot in unpaid claims. And this is a pretty significant amount of money, but a big issue is whether the trust contains, or what the trust contains for those unpaid livestock sellers.
Yeah, this is the first case involving this Dealers Trust Act, and so we're not sure of what the actual scope of the trust will be as interpreted by the courts. The statutory language can be interpreted a couple of ways. But what we're dealing with here is a massive case. We've got a couple of feed yards and then a cattle operation. These are in Texas and in Kentucky. And over 100 livestock producers have about $122 million in unpaid claims against these cattle operations. And the other issue is that there's a lender that says one of their feed yards sold about 78,000 cattle and didn't pay on the loans. Okay, so you have a prior perfected lender here. And normally what happens in a bankruptcy situation is that you've got unpaid cash sellers that aren't secured. You have a secured lender. You've got 78,000 head of cattle that were sold and the funds have not been accounted for. That lender is thinking, all right, I'm sitting here in first position. I'm going to get paid first. Well, now we have a Dealer Trust Act that says, now wait a minute, that the funds with respect to the cattle that have been sold are to be held apart from and separate from the bankruptcy estate so those cattlemen can get paid. So that's the battle. Normally, the cattlemen, according to the law here, if we're going to follow the Perishable Ag Commodities Act, that statutory trust, they would get paid in front of the lender. So we shall see. And as you're right, the question here is what's the scope of what's covered assets in the trust? What does that trust contain for those unpaid livestock sellers? Is it all of the assets of the debtors? Now, it could be, because for feed yards and cattle operations, practically all of their income comes from cattle sales. So that's a big issue. So far, the USDA has only approved for payment about $2.69 million of claims for the cash sellers of livestock, leaving about $120 million out there to deal with. The USDA is claiming that the balance is owed to the non-cash sellers that are not covered by the law. So the law is new. Not clear what a trust asset is for the benefit of the cash livestock sellers and what assets are in the bankruptcy estate. So that's a big one to keep an eye on.
Of course, you go back during the term of former President Trump, the Trump tax cuts, I guess it's also known as the Tax Cuts and Jobs Act, TCJA, and that one of the big things, of course, is concerning the corporate tax rate from 35 to 21%. But, of course, with everything, it has a start date, it has an end date. So there was a recent report that came out, what if the Trump tax cuts aren't extended?
Well, you're right. They looked at this, and these are economists. I find this interesting. Gregory, if you remember how well the economy was doing in 2019 before the virus hit, it was absolutely booming, and that was largely the result of the Trump tax cuts and the massive reduction in the corporate tax rate. We went from essentially a top end of 35% down to 21%, and that provision was made permanent. That one doesn't expire. A whole bunch of other stuff will expire at the end of 2025. Well, now we've got, and I'm encouraged by this because these are Ivy League economists and others and people in the U.S. Treasury that have said, now they put out an 85-page report and said, those Trump tax cuts, that corporate tax cut in particular, that's a pretty good thing. Because the rate went from 35 to 21%, also allowed for immediate expensing of shorter-term capital investments. Now, that has slowed down a bit. It was 100% bonus depreciation. Now we're at 80% this year, meaning I can go buy a $700,000 combine and write it off entirely in the first year with 100% bonus. Now, I could get 80% of it this year, and then I could take expense method depreciation and then regular makers on it. So I can get a massive amount of depreciation on that. Well, the economists looked at this, and they said in their report, I'll boil it down because it's really technical economic lingo and jargon, but what they said was that when companies reinvest the money that they have because they're getting this big tax break and grow and become more efficient, then what they showed was that employee salaries went up and more taxes get paid. So the result was no net loss to the Treasury over a 10-year period. And the report took a look at 2017, the year before the Trump tax cuts took effect, and said they said revenue to the federal government was, in that fiscal year, 2017 fiscal year, it was $3.3 trillion. Then in fiscal year 21, once the tax cuts were rolling and once we got out of the virus issues, the Treasury took in $4 trillion. So it went from 3.3 to 4 trillion with a massive tax cut on the corporate side of things, and 4.9 trillion in fiscal year 22. Well, then that's when the negative economic policies the inflationary policies the Biden administration kicked in fiscal 23, it dropped from 4.9 trillion down to 4.44 trillion because the economy had slowed, burdened by those inflationary and economic pressures and higher interest rates. So, pretty interesting report. And this goes back, we have historical data from the 1980s with the Reagan tax cuts of revenues to the Treasury going up while tax rates went down. It's a lot more detailed than that, but that data is all there. And that's what this most recent report shows. And I linked that in a blog article I posted this morning so people can go read that report. Now, it's pretty detailed economic and econometric modeling that's in there. So you have to have a lot of understanding of how that stuff works. But the synopsis is there, and you can discern from that kind of the summary of what their modeling shows.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us. Roger, I was asking you coming out of the break concerning the TCJA, the Trump tax cuts. When do we see those expire?
A whole bunch of stuff is going to expire at the end of 2025, and that's where I mentioned in today's blog article that we need to start thinking about the things that are going to expire and what we might be able to do to plan for that, because there are some things that are very valuable that are going to be lost, and some people are going to get a major tax increase if those aren't extended.
And that is and for what the cuts are and what they could go back up to, that is something that could definitely be of an issue or be of a financial issue coming up here in the not-too-distant future.
That's right, and it's particularly a concern for the lower income people. If you're currently in the 12% bracket, you're going to go back to 15%. So that's a 25% rate bracket increase on you. So basically, anybody up to about $90,000 is going to see a 25% rate increase here. Remember, the Trump tax cuts were very, very favorable to the lower end of income reporters. And the standard deduction was doubled. So the standard deduction is going to go way back down, basically cut in half. And now what a lot of people think of, well, they hear about the federal estate and gift tax exclusion, and it's $12.92 million this year. It's going to go to $13.61 million next year, and then probably another adjustment in 25 will take it over $14 million. Then that's going to get cut to roughly about $7 million. Well, a lot of people know about that, and they don't worry about it. Say, well, that's just for rich folks. But no, the lower end were the people that benefited tremendously from the Trump tax cuts. Another thing that's out there for sole proprietors, and this is a big one for farmers, sole proprietors and anyone that operates in any form other than a C corporation, you have a 20% qualified business income deduction. And so if your rate, say, is 24%, then you take 20% off of that for your business income. You're basically under 20% on your effective tax rate. Well, that's going to go away. So businesses, a lot of small businesses, they're going to see a 20% rate increase because that qualified business income deduction is going to go away. So those are some of the major ones that are out there. Child tax credit. You think of these families that have incomes less than $90,000 and have children. It's a younger family raising kids, struggling to meet ends with high food prices now and fuel prices. Well, if the Trump tax cuts expire, not only is your rate going to go from 12 to 15%, your child tax credit is going to go from $2,000 to $1,000, and so you lose $1,000 of credit per child. And a bulk of the major portion of that was refundable, meaning if you didn't have a tax obligation, the government would write you a check. Well, that's going to go away too if the Trump tax credit cuts are allowed to expire. So there's major danger out there for a lot of people if Congress doesn't deal with this. And we may get into a situation, Greg, where we get very late in 2025 and they haven't dealt with this yet. And it's going to create a lot of uncertainty. So this is one of the things we're talking about at the tax schools that I'm teaching across Kansas and elsewhere this fall. As what do we start talking to clients about, trying to get them ready for this, and what happens if Congress, what will happen to a particular client if Congress doesn't extend the Tax Cuts and Jobs Act provisions.
All right, let's go on to another topic here as we start to wrap things up. Pretty simple, but a case in court right now. As you titled it in your blog, you're responsible for filing your tax return.
Yeah, this is a case of first impression. We've never had one of these since the advent of electronic filing. Most people file their returns electronically now, and so you just turn things over to your tax preparer. Many people do, and that CPA or whoever it is files it for you. Well, you have to sign a document that allows them to do that, and that's the authorization to e-file. That's the Form 8879. But once they do that, here's the point. Make sure you have the person that filed the return for you send you the authentication that gives you certification that it actually got filed. What we have now is a court case where that wasn't done. The person just assumed that the CPA was filing their returns for them, and all of a sudden this guy gets an IRS agent at his work office saying, pal, we've been trying to contact you. We can't find you. We've been sending notices to you. No response. You haven't paid your taxes in 3 years. And this guy owed millions of dollars in taxes. This wasn't just a bit. And so his back taxes and penalties were outrageous. And he tried to argue that, well, my CPA was doing this for me. I didn't know anything about it. Well, the CPA had a whole bunch of problems. I won't get into that. And there was a separate lawsuit in terms of negligence against him, and he's no longer practicing. But the court said, the Supreme Court set down a bright line rule before e-file, and that is that you're responsible to make sure your return is filed. You can't delegate that to anybody else. And they said that's the same rule in the age of e-filing. So very, very tough case in that situation. The point is, make sure you have your tax preparer. If you're having somebody else e-file for you, send you that little notice that says the return has been received by the IRS. You need to have that in your possession.
Well, Roger, as you mentioned, you just posted this on your blog. All we talked about on your blog this morning. So if people want to get into more detail on what you have shown and posted as well, what's the best way they can do that?
They go to my website. The homepage is washburnlaw.edu/WALTR, and scroll down the homepage. It's on the left-hand side. They can also find that on the Ag Manager website, and now it can also be found on the RFD TV website.
All right, sounds good. Roger, as always, appreciate it. Thank you very much.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us this morning on the Ag Issues program here on 580 WIBW.